Welcome to the brand new series of ASM Connected, the podcast brought to you from ASM Technologies. In this episode, ASM Tech's Sales Director Ian Tompkinson and Account Director Stephen Dale are joined by Jay McBain, who is a Principal Forrester Analyst and 2021's Channel Influencer of the Year. Over the next 30 minutes, you'll hear some amazing stats, predictions and insights from around the industry, and thoughts on how emerging tech will impact the channel in years to come, the needs to be agile, how the US differs to Europe, and a surprise prediction. All of that's to come. This is ASM Connected.
So we're pleased to be joined today by Jay McBain.
Thank you so much for having me.
Both Ian and I have been using your stats and your predictions in customer presentations for quite a few years now, but it's great to be able to ask our own questions and see where that takes us. So we're going to stick to a bit of an outline plan, Jay, to try and keep us on track. We'd like to cover off emerging technology and innovation. We'd like to get a little bit into the need to be agile in the channel today, and then hopefully we can move on to ecosystems, platforms, and marketplaces. Does that sound okay?
That sounds great.
Excellent. Ian, do you want to kick us off?
Yeah, so Jay, I'll kick us off with I suppose, a nice, easy warm-up question, which will ease us into the conversation. And I suppose something that's very topical at the moment, particularly we had Freedom Day not long ago in the UK, where a lot of the restrictions from COVID have been released. So in terms of yourself and the channel, will you be switching your office chair for an airplane seat and a conference stage at any point soon, or have channel roles changed forever?
Well, I think two things. I think they've changed forever. That being said, there is going to be a return to travel. There is hybrid travel today. I do see my colleagues jumping out. There's an ASCII event that happened yesterday, and there's Robin Robbins events. And, there's several events. I went to an IT Expo event locally a couple of weeks ago, which had, a lot of sponsors and things like that. So there definitely is in-person events. I made a personal plan, given our situation, that I wouldn't jump on an airplane till after Labor Day in the United States, which is September. So I can see some fourth quarter travel happening. But in terms of your second question, I think things have changed where the first time people come face to face, and over the next few years, we're all going to focus on the personal elements of these events. The hallway chats, the hotel lobby bar, that's going to take precedent. And we're going to push these event hosts to record everything, so that I might catch the keynote, I might catch, a couple of key sessions in person. But most of the event, I probably want to put on my podcaster, my video, queue to grab on the airplane, to grab sometime else where I want to use that important face-to-face time for meeting people and reconnecting. And I think that's the hybrid going forward.
Yeah, that's a really valid point. I haven't actually thought of it like that. But yeah, a lot of the time will be used probably more constructively to do the face-to-face meetings, whereas the other things can be recorded and you can listen to them at your own convenience, I suppose.
Yeah, so content, and we're learning here. We're on this podcast now, and I listed a lot of the top podcasts, and we've got people that are either riding their Peloton, they're riding their bicycle, they're driving to work, and podcasts have become a part of, daily life. And it's a great way, conversational way to pick up good content. And I don't think there's any reason that I can't listen to a panel after the fact on my own time, when I'm plugged into doing what I do when I listen to podcasts. And that, very important hour can be spent, on the personal side, which I think is, and it's highlighted for all of us during the pandemic, how important that is again.
Yeah, no, valid point. And I suppose moving on to your role as a Forrester analyst, and stats is something that's at the core of everything that you do. And we've been, I suppose, I'd like to compare some of the stats and some of the conversation around emerging tech trends, which is very much at the forefront of our minds. And a few years ago, I know Forrester were tracking over 800,000 emergency tech companies globally. We've been tracking emerging tech vendors in our customer supply base, and we've seen an attrition rate of around 70% over 3 years, which is quite high. How do you think that sort of attrition and the take-up of emerging tech, will this scale and this pace of innovation, how will that impact the channel as you see it moving forward?
Yeah, it's a good question. And it wasn't so long ago that I came up with an epiphany around emerging tech. And I think, I probably wasn't the first to come with epiphany, but I had worked at IBM for 17 years of my career. When I went and looked up a couple of stats, because I know that IBM has a lot of scientists. I know they spend a lot of time in terms of creating patents around some of their inventions. What I didn't realize is for 28 straight years, IBM has led the patent race around the world. And
Wow.
in most years, it's not even close. I think last year there were 3 times more patents awarded to IBM than Samsung, who came in second. I scratched my head and looked at, the second thing, which is IBM has lost money in 32 of the last 34 quarters. For the last 10 years, it has been struggling to make money.
Wow.
And it's facing another, 1993, decline here. And I'm trying to figure out, like, in 28 years of inventing the future of Internet of Things and AI and automation and blockchain and quantum computing and VR, AR, MR and drones and self-driving cars, I could list off, 50 emerging techs. They're sitting on a mountain of IP. And how could you possibly be declining while other companies are growing? Like Azure is growing at 50% and AWS and Google are growing at 46%. And the SaaS companies are growing at 30%. RPA, which is a part of automation and AI, is growing at 81%. How could a company sitting on that mountain of IP not be monetizing that IP over 28 years? And the epiphany of around emerging tech is none of it is a product. And IBM, as a sales and marketing company, tried to bring all these products to market like they would a server, like they would a piece of software, and sell it through distribution and sell it through VARs and MSPs. And it's absolutely none of it is productized. So Watson 10 years ago was sold to us as a product that could cure cancer, nuclear explosions, could predict the weather. And 10 years later, we're finding out that it didn't cure cancer. And a lot of hospitals are actually sending it out because it's not helping the way that it was promised or overpromised back then. Where 10 years ago, if they would have spent their time selling into other emerging tech and selling into other software companies, for example, they could have sold that into Salesforce, and Salesforce would not have had to build Einstein. And so Watson could, almost like Intel, be inside everything we use today, and a little, sticker, Watson inside on the front of every product. But it's not, AI is not a product. Most of Internet of Things and most of automation and blockchain, none of it is actually the way we think about it in our industry over 40 years. It's all embedded, white labeled technology. And if your company isn't good at building out co-innovation and value creation, leveraging network effects, if you're not good at ecosystem, you're not going to be able to do that. The final part of the story is the CEO of IBM, the new CEO, after the most recent one was fired, has come to the epiphany as well and has committed $1 billion with a B to actually invest in ecosystem to drive this 28 years of innovation. And that's going to be, the kind of the march at IBM for the next decade.
That surprises me because, knowing the history of IBM, IBM were the very first company to embed another person's technology into their technology, i.e. Microsoft Windows, onto a PC. They were the very first people to be doing that.
Yeah, and if you read the book, and I was kind of, there through some of those early years, but if you read the book about, Bill Gates when he flew to Boca Raton, Florida, and, understand the creation of the PC and how they chose the Intel 8088 processor and Microsoft and the 11 other components, which were all external to IBM at the time, this was viewed as a hobby. This was viewed as a machine that, might only sell 10,000 units. This is the time at IBM, the redheaded stepchild. Here's a company that was selling mainframes to banks. And this small little tiger team out of, southern Florida was creating this. And they made that decision on purpose. It wasn't a mistake to give Bill Gates the keys to the castle. It wasn't a mistake not to acquire Intel. They owned 10% of Intel at that time. They could have easily bought Intel completely. Microsoft, there was a rumor they could have bought them for, something very small. Like we're talking a couple $1 million at that time. And if they did that, the PC would have never been in the way that we know it. The whole industry would have shaped up differently. And so that whole thing wasn't, as much of this wise, embedded, white labeled strategy as it was a offshoot, small test pilot for a company like that. So it was a mistake that worked out well for all of us, but I don't think it was as planned as people may think.
Well, one of the things that, Steve and I, when we're bouncing ideas around in the business, one of the things that we talk about on a regular basis is obviously the attitude to particularly end customers, which obviously has a direct impact on the channel, has shifted significantly to innovative technologies. And going back, talking about IBM, and 10 years ago, if it wasn't IBM or Cisco, people wouldn't really trust it. if it's not coming from one of the tier one brands, there was a real sort of trust issue, and it was a very difficult conversation. There's been a certain shift, particularly in the last, I would say, 5 years towards innovation. And, we're seeing that on a regular basis. Steve, I know we've talked about that pace of change a fair bit.
Yeah, I think from what you're saying now, it's about those critical decisions that these companies have made over the years. And what we see with the pace of change now is that they're having to make those decisions more often, and whether they get them right or wrong has such a big impact. So I talk to customers a lot this in terms of agility, and I find it a really fascinating subject to talk about, because we're usually speaking to our customers who are the big tech companies out there, and they're not normally the ones that are known for being particularly flexible. But what I'm seeing at the moment, and I'm quite surprised by, is some of the front runners that are leading the way, being agile, making the changes to the new ways, is not who you might have expected. So I'm keen to find out, Jay, what's your view on this need to be agile today throughout the channel, and kind of who's getting it right and who's getting it wrong?
Yeah, so there's massive changes happening in our industry, and there's massive changes in this new buyer. We spend a lot of time at Forrester researching this and writing about it. We know about these digital and digital-only journeys. We know that the demographics are changing in 4 to 5 years, as the majority buyer of technology will be a millennial. The biggest shift for all of us, though, is the decentralization or the democratization of decision-making. So 10 years ago, or 20 years ago, when you didn't get fired for buying IBM or Cisco or Oracle or SAP, this showed up on a big RFP, and it was procurement led. And these RFPs were millions of dollars, and you would never award an RFP like that to, 5 guys in a garage. You just wouldn't. And, even in managed services, you wouldn't award that to a small VAR. You always brought it, up to an enterprise level sale. Things shifted quickly, and we talked about it 10 years ago, called it shadow IT or rogue IT. And you'll notice we never talk about that anymore, because shadow IT won. Today, 65% of all business and SaaS decisions are made outside of IT, 2/3. So these don't start as $1 million procurement-led RFPs. They start as land and expand. Yeah. It starts with the first 30 days of a project. And you wonder how a company like Salesforce in 1999 got its start, started winning these little departmental deals on departmental credit cards, and started infiltrating its way into organizations to where today it's a $25 billion company. Last week, it surpassed SAP in revenue. It's worth more than Oracle on the stock market. It's a Dow 30 company, one of the 30 companies that everyone in the world watches every day in terms of their stock price. I think they'll be the next $1 trillion company. That's a grassroots, very divisional, departmental line of business purchase that's now taken over. So in the day where there's no $1 million RFPs, other business models now around agility. So Zoom, which got a lot of news this week for acquiring Five9 in CCaaS, which is contact center as a service. Zoom is a product-led growth company. There is no resell. The product itself sells itself at about 40 minutes when it's about to hang up on your customer. You quickly type in your credit card number. If 50 people from your company type in their credit card number, somebody from Zoom calls your CFO or CIO and says, hey, you got 50 licenses. Why don't you give everybody a license? We'll reduce the cost and we'll make it more secure and compliant. That's the product-led growth model. There are subscription and consumption models starting to serve this new buyer. Companies like Cisco and Dell and HPE and IBM and others, Nutanix, have gone all in 100% on subscription and consumption. So you won't be able to buy an HPE server come January. It will all be GreenLake, where you would have spent $1 million in your raised floor. Now it's $9,000 a month forever. That $9,000 is meant as a land and expand, and even can be afforded on a departmental credit card. So every company's moving these models, usage-based models, value-based pricing, and all of this connects to marketplaces, which grew more in 3 months last year than the last 10 years combined. So this whole change of procurement, this whole change in terms of where decisions are made and how money is spent, is having a revolutionary shift in terms of the channel. Much of it that relied on these $1 million margins, to pay their mortgage. And that's the big change that we're going through now.
Yeah, we've seen it, Jay. I mean, that shadow IT and that decision-making change, say it's gone on for a few years now. We've noticed it both from a sales and a procurement side of the organization, where we're having to go out and have more conversations with more people across the business. And I think you've said it before. People are savvy. People do their own research. People make decisions about the kind of technology they want to use. So we've kind of been rolling with that shift over the last few years. And I'd say we're getting used to that a little bit. But what I find interesting is when you talk about these first 30 days, and is it true, you think, that the big companies that have flipped to this subscription model, is it because they can afford to do that? Because I was thinking the smaller companies might have been the first to go to that new type of model. But is it a cash flow issue or something else that's meaning the HPs of the world are winning that race a little bit?
Yeah, don't be confused in any of this. This is the investors, the shareholders, the stakeholders that are driving this. If you're a public company, if you're a private company, your private equity or your venture capital board is pushing you to do this. They recognize the $5 trillion valued companies around the world, and they recognize that they are platform, ecosystem-led companies. And how they make so much money and why they're in court right now, most of the 5 companies are for antitrust, overtaxing their power on their platform, power on their ecosystem. Apple is in court with Epic. Google's been in court in Europe and in the US every day for years now. Microsoft has largely avoided kind of that the pain, but everyone else has been suffering from this. And this is the reason, is that they hold this power as a subscription model. And then the digital marketplace is this way that money changes hands. The fact that they now own and they're driving these enterprise credits to get all the money flowing digitally into their marketplace means that they can put taxation on it. I recorded a quick little video on YouTube on why Salesforce, as only a $25 billion company, is going to be the 6th company around the world valued at $1 trillion. And they're going to beat Cisco and Dell and HP and IBM. They're going to beat everybody else to it because of this model. And it is about valuation. Customers are not even that fast into marketplaces and subscriptions as these companies want to go. And every company in every industry right now are thinking about that. The people who make your peanut butter are trying to think about how the packaging can change, whether it sits on an Internet of Things weigh scale, there's a camera, the fridge, something is monitoring your peanut butter, and you set it and forget it. And every month, every 2 months, automatically, here comes a new peanut butter to replace the old. And now you've made your brand selection for life. People who make your car, people who make your toothbrush, everything you consume in your personal life and professional life. At least 76% of CEOs right now think that their current business model will be unrecognizable in 5 years. And they're all going into these consumption models, which actually makes a lot of sense. My printer calls home when the ink is low, which is great. And new ink shows up at my door, so I'm never out. The paper sits on a little weigh scale, Internet of Things weigh scale. When it gets down to less than 5 pounds, it triggers an order. And now those are 2 things I never have to think about again the rest of my life. I'm never going to run out of paper and I'm never going to run out of ink. And I shouldn't be spending any brain cells thinking about that. And it's good that all these companies are offering this up as a procurement or a consumption type of model in most of what you buy. So this is radically shifting business. And the ecosystems that come around this are the things that I study of how to make it all work.
So it's a bit like, I think you've said it yourself, Jay, that every company is becoming a tech company. And this is not you predicting the future, is it? This is all happening right here, right now. It makes those sort of short-term predictions a little bit easier for you because it's obvious how it's going and because it's moving so quickly. And you've talked a lot about ecosystems there. So I think that sort of pushes us nicely onto the next question I had. So I saw on LinkedIn recently that you've been tracking the uptake of this term ecosystem and how people are changing job titles, LinkedIn posts and things like that. It seems everybody needs to be either an ecosystem, a platform, or a marketplace, or maybe even all 3 at the moment. Do you see this as a big shift in almost renaming and defining what we do in the channel? And is it going to see a retiring of the old terms like sort of distribution, alliances, and resale? How big a change is that?
Yeah, it's actually not a change at all. It's a roll-up of all those things. Ecosystem is a third-party relationship that you have in your business. And it could be with your supply chain. For example, in your Apple iPhone, there's 900 different raw materials that go into making an iPhone. What's different is, some of those are mining companies in Africa that are mining resources. But the fact of the matter is many of those supply chain companies are jumping around with Apple and co-innovating, creating value, and then jumping further ahead in terms of driving other customer opportunities. So they're not just supply chain partners anymore. You think about the distribution, the routes to market and everything else. All of these players, like every customer of Microsoft, for example, are quickly becoming partners of Microsoft in the afternoon. This is why they're recruiting 7,500 new partners a month, because they are giving the tools on their platform for innovation. A customer can make a workflow or a piece of business logic or a specific set of processes, and they can codify them. And once they do that, they figure out that they could sell that to their competitors and they could sell that to other industry type players around the world. So each solution today has 7 layers to it on average. And the base solution could be a Microsoft or an AWS or a Google or an IBM or an SAP. The base platforms that we talk about, all the layers of security and automation and these workflows and something very minor are all part of this now. You can go to a GoDaddy and get a $5 URL. You can fire up a LinkedIn page. And by Monday, you are a vendor. And so like a company like Accenture, which talks a lot about ecosystems, they have over 1,000 software companies right now that they built around Salesforce by basically taking lightning flows and lightning bolts, which is kind of the RPA and the no-code, low-code platform on Salesforce, and creating some very specific last-mile industry software, which are nothing more than just simple workflows in a lot of cases, but they're actually selling them as products on the AppExchange. So when you name those 3 things, a platform is what every company wants to achieve in their industry. You want to be that base layer of that 7-layer cake, because that's where the most value is. When you earn that platform status and where a customer starts and innovates around you, and you're one of the suns that the planets rotate around, that has the most economic value. And back to our investors again, that drives the highest valuation for any kind of company. But the platform, and then you've got obviously this ecosystem of partners. So back to Salesforce, they're recruiting 250,000 new partners right now in their ecosystem, 250,000. And then the same day they announced that, they shut down their resale program. So there's no other way to get Salesforce than to buy it through the AppExchange. So you start to see the trifecta take place. Salesforce is this platform that offers up all these no-code and low-code and open APIs and business flows. They're also a company that has, hundreds of thousands of partners in with customers during their digital or digital-only journeys, to what they should buy. And then they've got Marketplace, which is the AppExchange. We ranked it number 1 in terms of feature and function in the world. It beat out Alibaba. It beat out Amazon, which 2 companies who know a lot about marketplaces. Salesforce has a better software marketplace than they do at this moment. And so they're going to tax not only the other software, the other 6 layers, which they do today at 15%, but over time, every dollar of Salesforce kicks out $4.65. 64% of that is professional services. So they're going to, at some point, probably take the money, all of it, $5.65 of it, and then they'll be the ones that pay out Accenture. They'll be the ones that pay out you, managed service providers and VARs and consultants and digital agencies and all the 16 kinds of partners that do all those professional services. They'll be the collection point of the money, and they'll be the platform that can tax it. So the ecosystem is directly linked to the platform and directly linked to the marketplace. They're all one and the same. And that's how companies of the future are thinking about agility.
That makes sense. That, and obviously there's a big control issue. I wrote down when you were talking before about changes, I wrote down cash and control, which is obviously key to a lot of this. But I think I saw Microsoft recently had reduced their commissions on their marketplace to try and drive vendors and people in. Could that be a sort of race to the bottom? Or once they've got control, are they going to prop that commission and costs up?
Yeah, so this was a monumental shift. And, when I posted that on LinkedIn, it's got like 100,000 hits because, in this decade of the ecosystem, we're very early. We're in the first couple of years of the decade. And, I was assuming a decade of where overtaxing, like things like Apple charging Epic Games 30%, is going to be defeated in court. There's just no way that consumers are going to be okay with a company who makes more profit every quarter than many companies' GDP every year, and somebody else's innovation at 30%. Apple charges newspapers and magazines 40% to be on the News Plus because they own the eyeballs. Between them and Google, they own 99% of eyeballs on mobile, and they own 86% of eyeballs on desktops and laptop browsers. So that is over taxation. That is over flexing power. And governments, the European Union and the US government and APAC, everybody's going to get on board to shut that down. But I think that most people agree that 15% isn't actually that bad because it's a lower cost to acquire a customer than other options. Putting a bunch of sales and marketing and other stuff forward and paying a channel to go resell it, 15 is a lot cheaper than all of that. So that's where I thought it would land. And when I said Salesforce was going to be $1 trillion company, I was using that 15% number as part of my calculation. And then Microsoft goes last week and drops it to 3 and basically tells the market that Microsoft's not going to profit off other people's innovation. The 3% is almost like when you swipe your credit card. There's 17 companies, mostly in New York, that make money every time you swipe your credit card. And that's the transfer fees and the movement of money and the cost of money and all the other things that go on there. And that's what Microsoft's doing is 3% will pay for the people and the technology and the servers to run that marketplace. And it's basically a break even. And we're not going to tax innovation. And I think governments really like that they're not taking advantage of their strength and their platform and their multi-trillion-dollar valuation. And I'm asking now whether other companies, like I think AWS and Google have to fast follow. On many of their big SaaS partnerships, they do offer, 3% as a way to negotiate down. But unless you're selling millions of dollars, it's tough to get to those numbers. Microsoft's allowing those 5 guys in a garage to start at 3, which I think is good for all of us. All boats are going to rise. And if everybody has to fast follow, this is going to change our industry, probably more than a lot of other things in terms of driving the future of innovation.
That's going to be a really interesting one to keep an eye on. And I think it's quite easy to get carried away with the big companies with this control. But the positive side that I'm taking from it is that there is a play in this for everyone, as you spoke about before. And I know from our experience, we speak to our customers about co-innovation and co-creation, which you mentioned earlier. And it is filtering down to all those levels of the channel. And we're all being asked by our customers to bring something to the table to that extent. So I do think there's a lot of positives for us to take out of it. And I know you've touched on a few things about the EU there and the USA. And I think Ian was interested to ask you something about those differences.
Yeah, one of the things that fascinates me is that there seems to be, in my opinion, quite a difference between the channel in the US and across Europe. Do you see a big difference in the two?
Oh, there's a massive difference. And, it goes in a lot of ways, but I'll start with distribution. In Europe, you've got 150 strong value-added distributors that drive local language, local currency, local taxation, local relationships, and really that ownership at more of a regional or industry or product or buyer type of basis. So if I want to go to market in Europe, I can be very selective across the 5 vectors. If I have a particular buyer I'm interested in Europe, if I have a particular sub-industry, there's 297 sub-industries. I want to go after 50 doctor clinics in Scotland. If I have, specific geographies, there's 75 countries in EMEA total. If I've got specific places I want to go, if I've got specific sector size and segment, I want to win the high side of SMB and the low side of mid-market, I can get very prescriptive. And then number 5, product areas. We're tracing 250 products across hardware, software, and services. And I can go and find a value-add distributor that specializes in my layer of security, for example. So those are the 5 kind of vectors from a customer perspective. And then there's 16 different kinds of partners. If I'm looking to acquire, or recruit managed service providers, there's the 6th vector right there. So in Europe, I can get out with, very surgical. I can get out my knife and try, and get very specific. In the US, you're faced with Ingram, and now Tech Data and Synnex have come together to become the largest distributor. I mean, you've only got a handful of these Fortune 500 size distributors. And you could be the 5 guys in a garage I talked about, and you walk into these distributors and they ask you for $1 million to put your logo on a page. And when I worked at Lenovo and when I worked at big companies, I used to sign over that $1 million check every quarter. They would send 80% of it to their bottom line. They might distribute $50 billion in products at break even. And the only profit they show to the bottom line is the marketing dollars behind the $1 million checks all the big companies write them. And it's so hard to get into the 200 vendor line card at these distributors, and it's a pay to play. And most vendors, especially SaaS companies and these cloud companies now, are finding, and security companies, there's 2,000 security companies in the channel, are finding that they can't afford a broad line distributor like that. It's not like the old model. And so going to market in the US, and this is what I publish a lot on my blog, the 143 social groups that partners are in, the 100 podcasts they listen to, the 54 magazines they read, companies take a very community approach and start to do grassroots level marketing. And those are the ones that are doing the best. The companies that are valued the highest, like a Datto is valued at 4.2 billion. A company I used to work for a little while at Autotask is worth today 4.2 billion. They've only ever taken a partner first community approach to winning. And today they're worth 3 times more than ConnectWise. But ConnectWise will go public and be valued at that as well. But these community companies are winning in the United States, and they're trying to take a lot of that community approach, into Europe and things like that. And that's starting to change the game a little bit as well.
Great. No, that's an insightful answer. Thank you for that. And probably, as I suspected it would be, that there is, very much a divide between the two. And I can see it coming closer over the coming years, which will be good to see. Lastly, just as a wind down question, one of the things that I normally ask guests on the ASM podcast for is their predictions for the top 4 of the English Premier League. But I thought it would be a little bit unfair to ask you that. So I thought I'd ask you for your predictions on the Super Bowl finalists this year.
Yeah, that's funny. I followed actually the most recent, what we call soccer, watched England and Italy go to the final shootout. And none of us in the United States, I'm Canadian, by the way, but none of us understand how you could take a championship or the World Cup into that kind of final. We love to play the drag down overtime that might run for 3 hours, but we want to see a goal scored to win. We don't want to see something like that. So all of our sports are made on these, you might stay up to 1 or 2 or 3 in the morning to see who the winner is going to be, but you feel satisfied. Whether you win or lose, you're going to have a real winner. So in terms of football, and again, I'm a Canadian, you could ask me about hockey. Tampa Bay just won their second Stanley Cup a couple of weeks ago, which is in my state of Florida. In football, Tampa Bay looks good again. Tom Brady was just at the White House yesterday making fun with Joe Biden about the election and everything else. And they're the first NFL team in 50 years, the Super Bowl era, to bring back all 22 players. Usually after players win a Super Bowl, they leave and go, sign a big paycheck somewhere else. They got a Super Bowl on their resume. This year, all of Tampa Bay, all 22 players sucked up their ego and re-signed, and many of them re-signed for less because they want to go win another Super Bowl. So they're the far and away leader. They have to beat, Kansas City, who has the next Tom Brady in waiting with Patrick Mahomes. It may come to another showdown between Kansas City and Tampa Bay. There's some other good teams, but they seem to be the 2 that people are watching.
Great. No, it's good to see that there are, I suppose, some trends with sports people as well. We see a lot with the European champions, and they go off and win the Champions League, and then that team is no longer because someone else offers a bigger price ticket somewhere else. So
the other thing we don't understand, and I've studied it as an analyst, is this injury or the fake flopping and injury. You look at somebody who doesn't even get nicked, and they go down like a bag of lumber, and they're wreathing, and it looks like they're close to death. And if a yellow card or red card doesn't come up, they pop back and they start playing again. In hockey, for example, I play hockey every week, and I've played since I've been 3 years old, which is law in Canada. But in hockey, we have players that have officially died on the bench and been revived and then asked to go back in the game. And I was taught that if your leg is still attached, it might be broken in 7 places, but if it's still attached to your body, you find your way back to the bench and you don't lay on the ice under no circumstance. So we look at the sport, and we know that you get more penalties by doing it. And unless the sport changes and starts calling this flopping and stops awarding penalties in this way, or goes to a video review of the injury, unless all this changes, it's going to continue. But it's really embarrassing to watch at times.
It is, and it's amazing that, in the UK, obviously, we've got the soccer and that takes on, but then we've obviously got rugby, and you'll see a collision there, and the guys are literally getting up bleeding, and they just get on with it. And
totally different. And you lose an ear, you just tape it up and keep going.
Yeah, absolutely.
Yeah, Jay, what I like, Jay, when asked for your sports predictions, I guess we shouldn't be surprised that rather than go with your gut feeling, you were going to pull out the statistics and have it all worked out already. So, yeah, we shouldn't be surprised by that.
Everything's about numbers, right? That's why I'm an analyst, I think.
Yeah. That's what Ian tells me anyway.
Very good. Well, thanks for the answers to the questions we've provided today. Great to catch up with you and to chat. Thanks for the All Things Innovation and channel. Thanks for taking the time to join us on the podcast. Really much appreciated. Great speaking to you. And we'll see how the future plays out. And we'll speak to you soon.
All right. Thank you so much. And look forward to coming back and talking about what we got right.
Yeah, great. Take care.
Thanks for listening to this episode of ASM Connected, the podcast from ASM Technologies. If you enjoyed this episode and want to find out more about ASM Technologies or about anything that's been discussed in the podcast, visit asmtech.com. And if you've enjoyed this episode, subscribe now and never miss an update. This has been ASM Connected.